Hi, everyone, and thank you for coming for today's financial wellness workshop, uh, Tax Bootcamp for Creatives by Sunny Widerman. My name is Tushar Dalvi, and my pronouns are he, him, and I'm the Community Engagement Coordinator at the AFC. Before we begin our chat, I want to take a moment to acknowledge the land I and the AFC are hosting this event from today. I and the AFC are located in Toronto. This is the traditional territory of the Wendat, the Anishinaabe, Haudenosaunee, and the Mississaugas of the Credit First Nation. The AFC is a national charity that serves people working in the entertainment industry from across the northern part of the Turtle Island, colonially known as Canada. Our offices are located on Dish with One Spoon territory, which is a treaty that has three guiding principles that serve as a reminder to the AFC of our responsibilities to the community. Number one, take only what you need. Number two, leave some for everybody else. And number three, keep it clean. Our work to serve and support the entertainment community on Turtle Island is an effort to ensure that everyone has what they need. And since the internet is allowing us all to come from so many different places for this discussion, I would like to invite you all to share this in the chat which traditional lands you are tuning in from today. If this is something you're not familiar with, I encourage you to take a quick moment to do so by searching to learn about the land you're currently on and who the traditional caretakers are. So, as I said, the AFC is a national charity, and we serve entertainment professionals in a variety of ways to help them maintain their health, dignity, and ability to work. With programs that focus on mental and financial wellness, as well as emergency financial aid. I'll take this moment to talk about the upcoming workshops. The next workshop is Somatic Tune-In with Maridora, which is happening on February 24th at 11 a.m. to 12:30 p.m. Eastern Time. Through guided somatic movement and embodiment practices, we will focus on softening the emotional body while strengthening the physical one and attune to the emotional landscape of the heart. After that, in March, we have another financial wellness workshop, Audit Proofing Your Taxes, again with Sunny, on March 5th at 1 p.m. to 3 p.m. In this workshop, you'll gain practical tools to protect yourself and simplify your tax process. Even if you've never audited or if never been audited, the tips you will learn about will make your tax preparation easier every year. I will share the registration links in the chat after the introductions. As I mentioned earlier today, today's workshop has been presented by Sunny Widerman. Sunny has been a tax preparer and advisor since 2002 with a growing clientele of freelancers, business owners, and professionals. Through her personal tax advisor, Sunny specializes in helping clients take control of their tax planning by explaining the tax issues that affect them. She focuses on a gentle, non threatening approach to financial issues and clear jargon free language. I'm also joined by Laura, our stage manager off camera. As you have been noticed today, we do not have ASL interpretation. We sincerely apologize for this inconvenience as due to some illness, one of our ASL interpreters were not able to join us today. However, closed captions are enabled for the live session and the recording will also include automatic closed captions. Some quick housekeeping before we begin. Please send your questions only through Q&A functions so our facilitators and us can keep track of them. Now you can also enable auto translate captions in 35 different languages at bottom of your screen. On the control panel, you will find captions feature either directly on the panel or hiding inside the three dots. Activate captions and select your preferred language. Please note the auto translate captions are not accurate. Just a reminder that the information in this session is not intended to be personalized advice. So some questions we may not be able to answer. I'm now going to hand it over to Sunny. Sunny, please take it over. Thank you.
All right. Thank you so much, Tushar. Let me just share my screen here. Let's see if that's function is working. Okay, and I will say share. Okay, hope that's looking good for everybody. All right. Okay, thank you, Tushar and Laura and all of AFC for having me here again to talk about your taxes. It's something I do a few times a year, generally this time of year. For some reason that I cannot understand. I don't know why people always want to hear from me in February, March, and April, but they do. And so we are going to talk about taxes for creatives. Tushar was kind enough to introduce me. I have nothing to add to that other than, you know, I became a tax professional. I didn't mean to. Nobody means to. I didn't mean to become a tax professional. It just sort of happened. I was looking for a little extra work to tide me over the spring, and I got a part time job, temporary part time job, and it became my life. Now, at that time, I was hoping to become a writer. So I was going to be a self employed creative, and I was going to do taxes on the side. And what ended up happening was I ended up doing taxes on the what's the opposite of the side, on the everything. And I stayed here, and I've been here now doing this since 2002. But since the beginning of my career, I've always worked primarily with artists and self-employed people, and that's always been my sort of my happy place. Um, and I recognize that for a lot of people, a lot of people are good at a lot of things. Some people are good at everything, and I mean that sincerely. But a lot of people who go into the creative fields um, may not feel that the world of spreadsheets is their home. A lot of people go into the creative fields because they don't like exactly the kind of thing that taxes require of us. So they're in a field specifically because they don't really want to know about the stuff that we're going to talk about today. They don't really want to deal with it. I don't mean they want to know, they don't want to deal with it. And I completely recognize that this may not be your area of strength. And of course, that's the point. We're going to try to bring you to a place where, at least, even if it's not ever going to be your favorite thing, at least you're going to be able to function and feel reasonably well oriented in this world that is not your world. So, um, I always like to start these talking a little bit about, because I did say that I do these talks several times a year. I do them for various organizations. I do a lot of them. And you'd think that after all these years, maybe I'd get tired of it. I never get tired of it. Um, and part of the reason I never get tired of it is because I'm acting from a place of inspiration. Um, I have I have an actual mission here. Um, And I like to start by telling a story. And some of you, we've got a lot of people on the line today, and I suspect that some of you have seen me have this talk before. And for them, I apologize for the repetition of the slides, the stories, and the jokes. I am not that creative. Ultimately, I do repeat myself. And so this is a story that I tell every single time. And for those of you who know this story, I apologize. I'm going to tell it again. So, um, the reason that I do these tax talks, my office was contacted one September by an actor, and she had been an actor for many years. She'd been making very modest money, but she hadn't been filing her income taxes. And which is understandable. She was an actor, not an accountant. It wasn't her thing, and she wasn't making a lot of money to begin with. Um, and so what happened was the Canada Revenue Agency sent her a letter, and they said, we haven't heard from you. We would like to see these tax returns. And she ignored that letter. So CRA sent another letter saying, we really want to see these tax returns. And then she ignored that letter. And they sent another letter that said, we really, really want to see these tax returns. And she ignored that letter. After a certain number of letters, um, CRA changes tactics. And they did for her what they do for a lot of people, which is that they just decided to file tax returns for her. Like they just made stuff up to file tax returns for her. And these are called notional assessments. Um, we usually call them arbitrary assessments because essentially the income tax people are just making up an income for you, making up a tax return for you, which produces a made up bill, a tax bill. And even though that tax bill is made up and CRA knows it's made up because they made it up, that's your tax bill. Unless and until you file your own version of the tax return. So, and usually your version is going to be better than their version. It's going to be better for you. It's going to have a lower tax bill. That's typical. So the thing to do in this situation is to file something instead. And CRA will take your version and overwrite their own version. They don't hesitate at all. They actually do want your version. In fact, that's what they want from the start, is they want your tax return. They don't want a made up tax return. They want the real thing. So she came to us to help her with 10 years worth of tax returns. And this kind of thing with people coming back and needing 10 years worth of tax returns, not as rare as you think, actually happens to us. It does happen to us a few times a year, several times a year, several times a year. Somebody will be 10 years behind. So it does happen. So she came to us to get some kind of fees estimate and a roadmap for filing 10 years of returns. So I gave her an estimate. It was as low as I could make it, given that I knew that she was in a bit of a, spot. She didn't really make a lot of money, but still, 10 years worth of tax returns is not free. And so when I sent her that estimate and I didn't hear back, I was not really all that surprised. Um, Now, one of the other things that had really um, one of the other things that had motivated her to contact us now was because after the arbitrary assessment, so when CRA makes up this tax bill, then they start asking you to pay it. And of course, she didn't pay it because she didn't have that money. So if you don't pay, what they then do is they start to garnish your wages. And so they started to garnish her wages. So just as a recap, garnishment is when CRA, they have to get a court order for this. They have to warn you that they're going to do it, and they have to get a court order. A court order that allows them to take the money that you earn before you get it. So instead of trying to take it from you, they intercept it between the payer and you. They step in. And the way that they step in is they send a letter to the people who pay you, people they have on record as having paid you. They send them a letter saying, we've got a court order. You now have to divert money to the government before it gets to this payee. So besides the fact that I mean, it's inconvenient to be garnished. It's unpleasant to be garnished. But on top of all that, all your employers, all your payers from the last several years get this letter. They all find out. So it's an awful situation to be in. Now, in the chat, not the Q&A, in the chat, does anybody want to put in their guess as to what percentage of her income they were garnishing or they were waylaying on its way to her? By the way, if you've been to one of my talks before, you're not allowed to vote here. Okay. So I'm seeing some percentages come in. You guys are all on the high side. Look at you, 50, 70, 60. Oh, Allison, 18. That's, it's nice of you to say. Okay. What a wide range. That's excellent. Okay. So I saw a vote here from, let's see. I'm going to give this one to Arlana, who guessed correctly. The amount that they were waylaying for her was 100%. They were garnishing her at 100%. She was so far behind. She had not responded to them in years. They made up a tax bill, and in support of that tax bill, they had now sent letters to anybody who might want to pay her to say that before they pay her, they have to send it all to the Canada Revenue Agency. So when we sent her a fees estimate and she didn't respond, I assumed that it was just because she had no way of paying this, which was possible. But actually, she got back to us a couple of weeks later and she apologized for taking so long to respond, which is kind of funny because I take 2 weeks to respond to anything. But she was behind for a reason, and that reason was that she had been evicted. So let's recap. She's got 10 years of returns to file. She's got an enormous tax bill that's going to stay there until she files something. and they're garnishing every dollar that she legally earns before it gets to her. And now she doesn't have a home. So this was, I don't want to bury you guys in jargon. This is what we in the industry call a disaster. This is very bad. It's a very bad situation to be in. You're between a rock and a hard place. You've got nothing but bills and no way of legally earning money with which to pay them. That is a bad, bad situation. Now, I will spoil the ending here. She was fine. She did not have to be homeless. She had friends. She got a loan. We were able to help her. There is a way out of this situation. Um, so if any of you are in it, uh, you know, I do have a guide as to what to do when you are behind by several years. I actually wrote an article for AFC about this exact topic. So there is a way forward. It is a lot of work. It's possible, but it's hard. And it doesn't have to be this way. If she had known what I'm going to talk to you about over the next hour and a half, 2 hours, she could have avoided the whole thing from the beginning. It is not fun to be great at your taxes for most people. Some people it's fun. Um, it's not fun for a lot of people, but it's not actually that hard. You just have to understand a few things about your life as a freelancer now. And if she had known these things 10 years before, the situation she was in would not have happened. And what I'm going to do in the next hour and a half is arm you with those things that she needed to know. I'm sure that had she known them, she wouldn't be in that position. Now, I am going to touch on a few things with a lot of details that are very easy for me to call up because I've been doing this and only this for 20 years. It will seem like a lot of information. I do have some free resources. I'm going to give you a link to download them after. So I don't want you to worry too much about the details of what I'm talking about here. I want you to put the pen down and just absorb if you can. If you can, okay, take notes. But I just don't want you to get so caught up in the details that you start losing track of stuff. I just want you to relax and absorb what I'm here to tell you, so that you get the whole gist of it by the time we finish here today. Okay, so this is why I do these talks to keep you guys out of trouble. And welcome to the wonderful world of self-employment. Um, Now, I chose this image um, for a number of reasons. I chose it with care. I want you to notice a few things about this. One is that there is no paved road here, right? This is a road that has been made by the tires of the people who drive it. And that is, I think, a very good analogy for being self employed. Every self employed person is essentially off road. The way, the way of things in the tax world is not clearly paved. A lot of the information that you're going to see out there isn't made for you. It's it's um, it's been streamlined for people who are living a different financial life than you are. So in that way, you're making your own road. It can also be very beautiful. It can be an adventure. You get to go where you want. You get to decide what's on the radio. You get to decide whether it's worthwhile to pull over to look at the world's largest blueberry. You get to do all that stuff. You get to have that kind of control that is only available to the driver. The downside of being the driver on a road trip like this is that you do not get to take a nap. You don't get to doze off. You actually have to be paying attention to a lot of details that passengers, passive people on these rides, do not have to know about. So, as a self employed person, you are automatically responsible for knowing more and doing more tax wise than a non self employed person, which may be the exact opposite of what you wanted with your life. However, it is unavoidable. So, that's what we're going to talk about. So, quiz question. And again, when I do the trivia questions and uh, quiz questions, just answer in the chat. It's not for the Q&A is for things you want me to answer for you later. So here we go. All right. Which of the following things do you need to have to be able to call yourself self-employed and write off business expenses. Is it a business number? Is it GST registration? Is it incorporation? All of the above or none of the above? Okay. Okay. We have like everybody's on an extreme here. Everything is like all or none, all or none, all or none. And the correct answer is none. You don't need any of that stuff. If you do a job or provide a service and you charge somebody for it, you're self employed. And if it costs you money to provide that service, you can write off those expenses. That is automatic. You don't have to register a business name. You don't have to have a GST number. That does not make you more legit. If you want to write off business expenses, all you need to do is charge for your services or your goods, whatever. Uh, Charge for your services and report that on your income tax as your gross income, and then you can start deducting business expenses. Business expenses are kind of one of the key things that separates self-employed people from employees. You know, um, what you get taxed on is not the amount of money that you bill. What you get taxed on is the amount of money you bill minus what you spent in order to provide the service that you billed for. So if you have, as a self-employed person, you almost certainly are incurring expenses in order to do your job. Those expenses typically are where those are where your business deductions are coming from. The cost of doing your business. The more business expenses you have, the less net profit you have, and you're being taxed on that net profit. So the heavier your business expenses are, the lighter your income tax bill is. Now, one nice thing is, especially in the modern age, is that a lot of things that maybe before you became self-employed, you were already paying for, or you would be paying for no matter what, uh, become business deductions as soon as you are self-employed. So as soon as you start, you have these things and they're just personal expenses, but as soon as you start doing work for money, um, that you're billing directly, these same expenses become your business expenses. So they didn't have a tax benefit to you when you were an employee, but once you become self-employed, they do. That's awesome. But beyond that, what are valid? What are valid expenses? I get questions about, is this a valid expense? Is that a valid expense? My friend says he deducts that. Is it okay? The problem here is that what is a valid expense is extremely, for the most part, it is very context specific. CRA does have some rules about stuff that they just absolutely won't allow, but that list is pretty short. And the list of things that could potentially be written off is essentially everything you could possibly spend money on could potentially be a business write-off to somebody doing some kind of business somehow. So the question is, what is a valid business expense for what you do? It's very specific to what you do. And there is no giant directory that says, yes, this is deductible. No, that's not direct deductible. Not really. Instead, in terms of business expenses, CRA applies a principle, a context specific principle to an expense to determine whether or not it's legitimate. And you should be applying this expense yourself, both because if you're ever reviewed by CRA, you might have to make this argument, so you need to know what it is. And also, as a business person, um, in terms of making decisions about what you're going to spend money on, you should be using this principle as well. So, what is the principle? The principle is this: the reasonable expectation of profit. Now, that is a very short phrase, and all of it is important. So, let's take it piece by piece. So, profit. I'm going to go back to first principles here. Profit is what's left of the income you build after you've paid out your expenses. So, if it costs you less to provide the service than the person has paid you to do the service or provide the service, you've made a profit, and that, of course, is the goal. But the specific way that it matters here is the expense should be smaller than the income it's generating, right? If you are pondering a $5,000 expense that's going to help you make an extra 200 bucks, that is not profit, right? That's not a profitable expense. That said, sometimes you'll spend money on something hoping that it will get you somewhere. You will spend some money on an ad or the casting workbook or taking somebody to lunch or whatever, um, because you thought it might profit you. It could have profited you, but it didn't. Maybe it didn't work out. The expectation in this phrase means that you only have to be able to expect that it will make the profit. Even if it doesn't work out, that does not invalidate the expense. The expectation is enough. However, that expectation has to be reasonable. And in CRA's world, when they use the word reasonable, what they mean is from the perspective of a disinterested third party, a reasonable disinterested third party. And by disinterested, we do not mean bored, of course. What we mean here is a person who has no dog in this fight, who has nothing to gain or lose by the outcome of the argument. Somebody who's just looking at it objectively from the outside, who is a reasonable person. Would they say, yeah, there was a reasonable expectation of profit? If the thing that you're trying to deduct is not specifically disallowed by CRA, and if it matches this criterion, the reasonable expectation of profit, it's probably a valid business expense. Now, I see a lot of questions coming up in the Q&A, so I'm going to take a look and see if I've got some answers for you. There's a question here about a person who has passed away. How does that affect taxes? There's a lot of things to consider there. That is a little more personal. We might actually have to have a talk about that. But in general, when a person passes away, their final return has to be filed as usual at tax time, or sometimes a little later if they passed away late in the year. And that return is a special return, and you should probably get some help with it if you've never done one before. Can you please highlight any differences between artists who are self-employed and those who became incorporated? Again, I actually did a workshop about that for AFC last year. The entire workshop was kind of just about that. So this is not a simple answer, but I'm going to give you the quickest answer I can. When you incorporate, you've created a separate entity like a different person. That person has its own income and expenses. And if it has a profit, or if it is able to, it pays you as a human being an income. So in terms of how the profit calculation goes, corporations aren't that different from sole proprietors, but the fact that a corporation is separate from the human being who is being taxed on their income means that there's a lot of sort of movements that can be done in between these two entities. And because those movements can be complex or confusing, the tax filing for a corporation is a lot more stringent and a lot more complicated than the income for a self-employed person, even though they're fundamentally the same thing. It's that there's a lot more tracking that has to be done because having a corporation allows you to make a lot more moves. It also is under a lot more scrutiny. I will say that if you are only making enough to live, or if you are only making enough to, let's say, pay yourself $120,000 a year or less, it's not, from a tax perspective, it is not worthwhile to be incorporated for the most part. Now, I know that's going to be controversial, and I don't have time to go any further into it, but I just want to answer that question before we even go there. If you're making less than $120,000 a year of profit from your self-employment, don't even think about incorporating. It's really not worth it. And it's not even worth it a little bit higher than that. That is where it barely begins to maybe be worth it. So don't even think about it if you're making less than that. Okay. You said we can start deducting business expenses as soon as we're self-employed, but do we have to right away? I mean, for example, last year I only made $100. CRA certainly does not insist that you deduct business expenses. You absolutely do not have to. And if your income is very low or your expenses are super low and it would be more trouble, like any expense that you can write off is going to save you some tax if you make enough to be taxable at all. It's going to save you somewhere between, well, for most people, your tax rate is about 30%. It's not exactly, use that as a ballpark, meaning that if you have an expense, a business expense of $100, declaring that and writing it off will save you $30. So there's definitely a point where your income is low enough that you're not getting taxed that much to begin with, or your expenses are so low that putting it together and writing it off is actually more work than it's going to save you. Like you could make more money working a shift at McDonald's. If that's the case, there is no law that says you must write off your business expenses. It's something people do because it reduces their taxes. They do it because they want to. And CRA certainly doesn't mind if you want to just pay the extra tax and not bother. Okay, we'll do a couple more and then we'll move on. Give me a second while I read some questions here. So here's a question that I already answered, but I'm going to answer it again just in case, because it's important. The question was, if one is spending money on promotion, trying to get business or a project, but no income, there's no income at all, such expenses cannot be claimed. Is that right? Not exactly. It's best to not claim expenses until you have some income. And I mean some, like 10 bucks, like anything. It's ideally you don't want zero income and a bunch of expenses. But that said, even if your income is very small and basically your promotional forays didn't really pay off, as I said, it's only the reasonable expectation of profit. If you incurred these promotion expenses and the expense that you were spending was sort of a reasonable amount, trying to make money that was reasonably likely, even if it didn't really work out, it's still okay. What happens if you provide the work or service and are not paid for it? Is there a way to deduct the negotiated fee? So if it depends on how you accounted for the project in the first place. If you did the project and let's say you were going to bill them $1,000, if you declared the $1,000 on your income tax return, even though you hadn't been paid it yet, you were sort of counting your chickens before they were fully hatched, which is actually fair in accounting world. There is a way to deduct that the next year. It's called bad debts. So you can deduct it off of next year's taxes. But most people who are self-employed and are sole proprietors basically don't report the income until they are paid it. So if you never got paid the income, there's nothing to deduct. You just have no income. So I hope that makes sense. Okay, I'll do one more. If you're working for another self-employed person and paid hourly on a part-time basis, can you deduct your transit expenses for traveling to provide those services? Usually, yes. However, CRA makes this very confusing distinction between traveling expenses and a commute. If you're going back and forth to a place of work where you typically do your work, let's say you have an ongoing deal with this person and they've got a desk for you and you're traveling to and from that desk, that is not deductible. I don't think that's fair or right, but that is one of the few limits that CRA has. That if you're traveling to and from a place where you regularly do your work, it becomes a commute and it's no longer deductible. But if these are ad hoc meetings, just from time to time, you run out there and they're not always to the same place, or maybe they are to the same place, but they're still kind of ad hoc. There's no predictable schedule to them. It's not normal. In other words, there's no real regularity to it. Or if there's no regularity to it, both in time and in space, meaning there's no regularity to it in terms of time, in that It's not a regular schedule. It can happen anytime. Then it's not a commute usually. Or if you're going to different places at different times, every trip is kind of different. It's also not a commute, it's deductible. But if you're going back and forth reasonably predictably, like once or twice a week or once or twice a month, and it's always in the same place, that would probably be considered a commute and it's not deductible. Okay, let's keep moving. What is the most common trigger? By the way, if your question hasn't been answered yet, that doesn't mean I'm not going to get to it. But we do have a lot of participants on the line right now. We have 168 people on the line right now. The chances I'm going to get to every question in the Q&A is small. But the fact that I haven't answered your question yet doesn't mean I'm not going to answer your question. We're just going to try to get all the material in on time. Okay. What's the most common trigger for an audit? Again, this is something I'd like you to answer in the chat. Is it claiming a business expense that is not valid? Is it significant changes in your income from year to year? It's going up, it's going down, it's going up, and it's going down. Business losses from year to year, or dumb luck? What is the most common trigger for a review or audit from CRA? We got some D's, we got some B's. Why, oh, why? This is what I like to see, a nice wide variety of answers here. The correct answer, if you're ready, is dumb luck. The most common reason that CRA will contact you and ask you for clarification is either because they're doing a spot check of things that they typically don't collect supporting documents for. So, for example, um, if you say that you gave to charity, these days when you file electronically, you don't submit your receipts for that. You just say it. CRA will occasionally write you a letter and say, "Show us the receipts." That's a spot check. That's dumb luck, right? They just randomly pick you. But in terms of reviewing your business expenses, the number one reason is just because CRA happens to be looking into your industry. So when you file a tax return each year, you enter a 6-digit code that indicates what industry you're in. There will come a time when CRA will say, you know what, we haven't checked out we haven't really checked out what the actors have been doing lately. Let's see everybody who used that 6-digit code and let's grab a certain percentage of them and just look. So if you happen to be in the industry that CRA is looking at that year, suddenly your chances of being audited have skyrocketed through no action of your own. It just happened. People are always asking me if such and such will get me audited. If I do this, will I be audited? The fact is that until you're audited, CRA takes almost everything you say on faith. First of all, the return that they receive is a very stripped down return. When we file electronically, we've gone to all this trouble to deduct accurate business expenses and to stay within the law and to stay within what's reasonable. They don't see any of that. When you file a return, all they see is money in and final profit. They don't see any of the calculations that went into finding that final profit. They don't see it until they choose to audit you. And so it's far from the case where an illegitimate expense will trigger an audit. Actually, what happens is those illegitimate deductions get revealed by the audit. So they choose you for an audit first, and then they discover these. Now, we are always trying to prepare an audit-proof review, an audit-proof return, to make sure that if you're chosen to be reviewed, your return will withstand it. Because an audit is out of your control for the most part. Not every audit. There are some situations where people's past behavior does trigger an audit, but for most people, it's just random. And I can no more easily tell you how to avoid getting audited, except in some weird situations. But for the most part, for most people going through their lives and being self-employed, it's like avoiding a tornado. It's, wrong place, wrong time. And yet, a tornado passes through, and you'll sometimes have a situation where the tornado passes through, one person is devastated, and another person also in the same situation is fine. That happens actually quite a lot. Some audits are brutal, and some audits are essentially an irritant, a slight irritant. What is the difference between having your house blown down and losing a couple of shingles? Why does it happen like this? And the fundamental answer is your record keeping. If you keep poor records and you get audited, you are going to have a very bad and very long, protracted time of it. And if you have great records and you can find everything, everything is defended, everything is supported, everything is available, you'll be fine. So, great records, by great records, I mean that if CRA digs deeper into an expense, you can prove that you paid it and you can explain what it was and you can explain, if they ask, why you have a reasonable expectation of profit. You can defend it because you've got your documents, dates, amounts, everything. So, what exactly constitutes great records? What do you need to keep? Well, as a self employed person, I often get asked, people often ask me if they can just keep their credit card receipts. And credit card receipts, credit card statements. Credit card statements are really tempting because they're so tidy. It's a single piece of paper. It comes once a month. Everything is listed there. I mean, what's not to love? The problem is that they're not sufficient, according to CRA's rules, to to perfectly defend an expense, to impeccably defend an expense. If you want to be able to defend that you spent the money that you say you spent, your document has to include the amount, the date, and the name and address of the person that you paid, which fundamentally means cash register tapes are our king here. If you actually buy something with a credit card, you have to keep the receipt that you get at the cash as well. That is the actual, irrefutable, totally defensible proof of payment. Um, Now that doesn't mean that automatically, if all you have is your credit card statement, that you're screwed. It doesn't mean that. If CRA reviews an expense and the only evidence that you have that you paid it is your credit card statement, first of all, that's a lot of steps, right? They have to review you, they have to review that exact expense, they have to ask for the documentation. So any one of those steps could just not happen. But if they get that far, it's possible that you will get an auditor who's in a good mood and gets it and just says, fair enough, close enough, and just lets it go. The problem is they don't have to let it go. They don't have to accept it. So with a cash register tape, they kind of have to accept it. So have that cash register tape. How long are you going to keep them? You have to keep them for 7 years, starting from the later of the filing date or the year to which they pertain, in case CRA asks to review them. So why I give it 2 ways is that, so for 2026, which is what we're in now, the records that you're collecting now, you have to keep for 2026, 2027, 2028, 2029, 2030, 2031, 2032, 2033. That's how long you have to keep them, minimum. Now, let's say that you fall behind in your tax filing and you don't file until 2033. Can you just throw away the receipts because it's already 2033? No. The clock starts when you file. So now you have to keep them for an additional 6 years after the year in which you filed. So holding off by 7 years does not relieve you of the duty of holding on to all those receipts. The receipts have to be held for a minimum of 7 years, maximum 6 years after you file the return. Um, so a lot of this is basically good financial hygiene. It means you're going to save those receipts. So you routinely have a place to dump them. So you have them all. You don't have to organize them as you go. You can organize them once a month, once a quarter, once a year, doesn't matter. But make sure that you at least have them. So you should have an easy system for dumping receipts, a single place where you put them all that's easy to get to. So you can just, so that your habits are friction free in terms of getting that supporting document saved. You've got to have a place to dump it for the physical receipts, and preferably a place to dump it on your computer for your electronic receipts, but a place that supports the habit of saving them all the time. You should be filing your returns regularly, so that you're not falling behind, because falling behind, you fall behind if you don't file 1 year, the next year. Now you have a tax, it's time to file your taxes, which is already a big job. Only now you've got to do 2 of them. So then you don't do that because it's hard work, and it's more work than you're really ready for. So you miss it again. The 3rd year, you've got 3 returns to file. The job just keeps getting bigger. It's much, much better to file the returns regularly if you possibly can. So that's what I mean by good financial hygiene. I will say for myself, I hate flossing. It's annoying, it's boring, it's time consuming when I'd rather be doing something else, right? What does that sound like? That sounds like keeping good records, right? It's boring. Um, and yet I do it. Why? Because the consequences of not doing it are so much bigger. That's why. Okay, we'll answer a couple of questions and then we'll take a quick break. All right. Um, is claiming mileage to and from a rehearsal reasonable, or should it just be one way? It's round trip from your home out there and back again. And, as long as we're talking about um, car expenses, um, to be valid, you are supposed to be keeping a car log, um, a log showing uh, where you went and how many kilometers you put on the car doing that, in case CRA asks for proof of what you say you spent on your car. So you have to keep a log. Um, so why? Oh, sorry, that shouldn't be there. That's a log car. A car log is a record of your trips with dates and distances and purpose. Now, in the old days, you could have just, in fact, you can still do this. You can just have a notebook in the glove compartment where you just sort of jot it down. You can jot down the odometer reading before and after, and you can jot down what it was and the date. That's good enough. But obviously now there are lots of apps you can put on your phone that'll just, you turn them on, they measure the kilometers, by GPS, and then you turn it off when you get back home again. So, and that automatically records the date as well. So you should put in a memo as to what it was all about. So, yeah, you can write off the mileage both ways, but be sure to keep a log. Um, what about not writing off to have the RSP room? So what this is referring to is the amount of RSP room that you have is based on your earned income, which includes the profit from your self-employment. So it's true that the more you write off, the less profit you have and the less money you can put into your RSPs. I would say 2 things about that. Number 1, not earning the income means you don't need the RSP to offset that tax, which is what that's for. So there's no real, in terms of the tax deduction, there's no net advantage to not writing off the business expense, so that you can instead put the money into an RSP. You already spent the money on the business expense. That money is gone. The only way to reclaim a little bit of it is to write it off properly. If you don't write it off, you're just out of pocket. Yes, you've got a little more RSP room, but you don't need it because there was no, you've made your income bigger, so you have to pay more tax. And then you put the money that you didn't deduct into an RSP, so it brings the tax back down, but it's a zero-sum game. And meanwhile, you're out of pocket the extra money. So I wouldn't really advise that as your purpose. Now, there is a second advantage to RSPs. The first advantage that most people are thinking about is that when you put money into an RSP, it reduces your taxes at that time. The other advantage to an RSP is that any investments that are inside an RSP grow tax-free. So they're growing faster, which over the course of a long time horizon, like 10 or 20 or 30 or 40 years, is really going to matter. The fact that they're untaxed while they're growing. However, a TFSA will do the same thing. It grows tax-free and it is not dependent on your income. So if you're looking at not writing off business expenses in order to increase your RSP room, I would say if you haven't filled up your TFSA, which a lot of people have not yet, go back and do that instead. Write off the expense and put the money in the TFSA. You can get the RSP room later or another way, like by making a lot of money. Okay. Um, I only work as an employee for film production. Can I still write off tools that I buy to use at work? Or should I try selling things I make so I can write things off? Okay. Employees from from the start cannot write off expenses unless they get a specific form from the employer saying what they have to provide out of their own pocket. The form is called a T2200. I'm going to put this in the chat. That's what it's called. And it is a list of things that the employer says this person has to supply in order to do this job. And it essentially unlocks the ability to write off expenses, only those expenses and subject to CRA's rules. I will say that what you can write off because you have a T2200, even with the best 2200 ever, is less than you can write off as a self-employed person. So it's not as flexible, but it is the only way if you're for income for which you are an employee, the only way to write off expenses relating to that income is to have the T2200 supplied by and signed by your employer. Now, should you try selling things so that you can write things off? When it comes to self-employment, your goal should always be profit. Sell things to make profit. Remember that you can only write off expenses related to that self-employment income. So you can't write off an expense that you incurred to do an employment job for which you're not allowed to make deductions. You can't write those off against your self-employment income. The expenses you write off must relate to earning the self-employment income. They have to be when we talk about the profit, the reasonable expectation of profit, the self-employment profit, the income from self-employment minus the expenses incurred to earn that income, not some other income against which you're not allowed to make a deduction. So if you want to sell things you make, do so, but do so from the perspective of making a profit on that, um, judged from what you make by selling them minus what you spend to make the product. Um, Being a contractor music teacher at a music school, can mileage be claimed? If you're always teaching at the same music school, it's a commute. So not really. Um, would a capital gain from selling a house trigger an audit when past years have been much more simple? No. And I'll tell you another thing here. Let's look at a very specific thing here. You've made a capital gain. Capital gain, for those who don't know, is when you own something for other purposes and then you sell it and you sold it for more than you bought it for. So there's a profit there called a capital gain. First of all, only half of it has to be declared on your income taxes. Second of all, the capital gain is something that the Canada Revenue Agency probably doesn't know about, except that you told them on your tax return. You have volunteered this information, as you should. It's taxable. And if they find out that you made a capital gain and didn't report it, you're in trouble. So don't do that. But if you have a capital gain and you report it, you're saying to CRA, here's some money you don't even know about. I made this money. Tax me on it. Logically, if you're CRA, are you going to dig any deeper in that? Because the person volunteered that they made more money, is essentially volunteering to pay you more tax? Is that the return that's going to get audited first? No. Volunteering that you made more money that CRA has no record of. There's no T4, there's no T4A. Remember, all those slips get reported to CRA too. But when you sell your house, they don't get nothing. Reporting that income is not going to get you in trouble. Okay. What if the receipt is damaged due to fading over time, water exposure, or other factors? Um, don't let it get that far. Photocopy your receipts before they fade. So photocopy your receipts on a regular basis because, yeah, we have all these receipts that are sort of printed on that shiny paper and they're printed with heat and they fade. We know they fade. Photocopy them before you can't see them anymore. So put them on a photocopier. Sometimes you'll find if sometimes you'll find that you've waited a little bit too long and the receipt is sort of yellow and you can read it, but when you put it on the photocopier, it can't read it. Um, Pro tip, switch the photocopier to photo mode. Photo mode is more sensitive. It'll pick up the same fine detail that you can pick up with your eyes, and you'll have a proper record with the name and address of the vendor and the amount and the date. So photocopy your receipts, don't let them fade, because like it's fine for personal stuff. It's fine for your grocery receipts that you're never going to use again. It's fine for most people in ordinary life, but you're not most people, and self-employment is not ordinary. These are receipts that are worth money, so you need to take care of them. Photocopy them. Okay, I think that now would be a good time for a little break. It's about 4 minutes to 2. Um, so how do people feel? And I'm going to put up a link for my resources in a moment too, that I'll leave up during the break. But how about if we took a break until, how about 5 after 2? So a little bio break, little breather. I'm going to, I don't know, get a lozenge or something, and we'll regroup here um, at 2:05. All right. So I'm just going to turn off my camera and I'll see you then. Okay, we're close. I think we're at 2:05 now. I hope everybody had a nice break. I had a delightful break typing as fast as I can. Um, there was a question here in the Q&A that I meant to type the answer to, but I clicked the wrong button. So now I'm going to answer it live. It's a good question anyway. Um, I'm going to read the question, I'm going to answer it, and then we're going to move on. I had a job on payroll, a salary job for a couple of months where they deducted taxes, and I had some freelance work in which I earned less than the basic personal amount. Do I still need to pay extra taxes for the freelance work? Um, well, both payroll and freelance income together total is barely over the basic personal amount. All income earned anywhere in the world must be reported on your income tax return, except for certain completely exempt income, like income from inheritances or gifts. So you would have to report all that income, it's true. Um, and there are other, your tax return does more than just calculate your taxes due. It also calculates your eligibility for certain credits and benefits, many of which those benefits are related to lower income. So the less you report, the more you get. But some of them actually have a sweet spot. So you need to be close to a certain target to get that credit. So either way, if you're filing an income tax return, and especially if you are applying for the kinds of credits that are available to mid and low income people, you must report all income from anywhere in the world throughout the year. That's the law. So, okay. All right. Here we go. Now, a topic that everybody loves. Let's talk about the GST in a nutshell. Um, so I love this topic. There's so many questions about it. I will not be able to answer all of them. I know my limits here. I'm doing my best, but we're gonna try. So, but what I'm going to try to give you is like a basic understanding of the gist of the GST, the gist of the HST, and at least you'll have some kind of place to stand next time. Okay. So first, let's talk about the terminology. The GST stands for the Goods and Services Tax, and it is a sales tax applied federally. So throughout the country, the GST is applied everywhere, and it's 5% everywhere in Canada. Um, some provinces, most provinces, also have a provincial level sales tax that they'll call the PST, or in Quebec, the QST, because Quebec is always different. So there's two sales taxes, the federal level sales tax, that's 5% everywhere, and the provincial sales tax, which is different depending on what province you're in. And then some of the provinces that have provincial sales tax have decided to combine these two sales taxes into a single sales tax called the harmonized sales tax. And why did they do that? Frankly, to make the paperwork simpler, to make filing simpler. Provinces where there's a separate, where there's a PST, but they haven't harmonized, a person who's got goods and services to sell may be filing two returns about their sales taxes. Those returns may have different deadlines, different rules, different reporting. The numbers that you report may be different because they reflect different things. And you have to know them both. In a harmonized province, you only need to know one set of rules. And it's the same as the GST rules. So an HST, the HST and the GST are basically the same for the purposes of when we're talking about the rules. The way they're different is provinces that have an HST, because they're combining the federal tax, which is 5% everywhere, with the provincial tax, which varies from province to province, even in provinces that have harmonized. So the HST can be different from province to province. So I'm in Ontario. Our provincial sales tax is 8%. So our HST is 13%. It's 5 plus 8. But if you go to uh, New Brunswick, their provincial sales tax is 10%. Yes, 10%. And so their HST, because they're also harmonized, is 15%. So HST is not the same everywhere. The underlying GST is the same everywhere. It's 5%. So when I talk about the GST or the HST, the rules are the same for both of them. So if I say GST It's also true of the HST. And if I, other than this, the fact that they're different from province to province, when I talk about the rules for the GST, it's the same as the rules for the HST and vice versa, in case I forget to say both at some point. So let's get to the nutshell. Um, I'm going to explain the entire GST system on this slide. I'm going to point out a couple of things. There's not a lot of room left on this slide, and I still think I can do it. Let's see how I do. Okay, so number one, GST is a tax that if you're a GST registrant, HST registrant, you're going to charge it on top of the fees you charge. These are separate things. Your fee plus the tax that you're going to charge on top if you are a GST registrant. You charge it on top of your fees. Then you're going to take all the tax that you collected, and that goes to the government. So any GST that you're collecting or HST that you're collecting, set it aside, don't spend it, it's not yours. Ultimately, it's going to the government. However, as a GST HST registrant, you also have the right to claim back from the government any GST or HST you spent on your business expenses. So any expenses that you're deducting, if you spent, if you paid GST or HST on those expenses, you're getting that GST or HST back if you're a GST registrant, not if you're not. And finally, you have to inform CRA of that calculation, because actually you don't send them a certain amount of GST and they send you a certain amount back. Instead, you calculate what you owe them after everything is said and done. So you calculate what you're supposed to send them minus whatever they're supposed to send you back, and you send them the difference. So you have to file a return regularly to sort of show what you're reporting for all those amounts. So why are you sending them a check for this amount? This is why, because the return explains how you got there. So what a lot of people are aware of is that there is something about 30,000. Now, I am convinced that not everybody understands what it is about 30,000. So here's what it is. 30,000 refers to the money that you bill for self-employment. Okay? It's the amount of money that, it's not the net profit, it's the amount that you're being paid. If your self-employment income, and this is from anywhere in the world, all combined, if your self-employment income is below 30,000, you do not have to register for the GST HST. You can choose to opt out. Above 30,000, you must register. So once you hit the 30,000 mark, you register and your responsibilities begin there. So from the point that you register, that's when you start collecting, that's when you start filing returns, that's when you start being able to collect back any GST or HST you spend. If you hit 30,000 partway through the year, you are not obligated to send them GST on the money that you already billed. You're not registered yet. It starts when you register. People below 30,000 can choose to register for the GST HST, but it's not mandatory. People above the 30,000 line do. What's included, once again, it's from self-employment, from any form of self-employment. So if you do two very different things, so let's say you're a painter and also a singer, and your income from these two things adds up to more than $30,000, you have to register. However, if you also have a salaried job, or if some of your income as an artist comes from grants, those are not included with the 30,000 to determine whether you are obligated to register. Okay, so they may be taxable, but they're not part of this $30,000 rule. Only the self-employment income is. So let me show you visually how it works. Let's say you're not registered for the GST and you do a job and you bill for it. So this is the amount that you billed the payer. In order to do the job, you had to spend some money. So that went off to the vendors, and this is what you're left with as your profit. It's a very simple picture, okay? Compare that to if you're registered for the GST HST. So you're going to bill the same amount. You're billing the same amount, but on top of that fee, you're going to have to charge the tax. It's still true that you have some business expenses that you incurred in order to do this job, But embedded in those business expenses also was some GST, HST, because you're here in Canada, stuff costs, stuff has tax on it. So you spend it. You take the money that you build on top of your on top of your fees, that's going to the government. You're also going to claim back what you spent on your business expenses. And so you're left with this. So everything below that dotted line is extra money that's in your pocket because you're registered for the GST, HST. There's no scenario where you end up being poorer because you are registered for the GST, HST. If you've done things properly, that you registered, you started billing it, you sent it, you claimed it back. There's no situation where you're not at a financial advantage to be self-employed. To be registered. However, being registered, as I said at the beginning, has these obligations. So yes, you're a little financially better off. But now you have to charge it. Now you have to file this extra return. Now you have to remit this extra money. It's just another thing to keep track of. So even though you're financially ahead, you may not feel like you're ahead, and you may not really want to do this, and you may not feel like registering. I get it. I get it. However, if you don't register when you cross the $30,000 line, um, at that moment, you're the only one who knows that you've crossed 30,000. So not registering will have no immediate effect. Nobody will know. It's fine. But, as much as people they ask me a lot about red flags. You know, if I deduct this, is it a red flag? We know now they can't tell what you're deducting, so nothing's a red flag. If I do that, is it a red flag? If I sell my house, is it a red flag? If my income goes up and down, is it a red flag? Audits are not that common. But what happens with the GST is that CRA will look back over your past few years of tax returns, and they do see the separation of your self-employment income from your salaried income. They can see how much you build or how much you say you build. If they go back and see that you cross the $30,000 line, and then they go over and check to see if you have a GST account and you don't, what they'll do is they will back register you. So they'll say, we've decided that you were registered in 2022. And then they will ask you for GST that you never actually collected. That is the one situation where you are really poor because they said, well, you know what? You're supposed to be charging 5% on top of all your fees. Give us the 5%. You owe it to us now. Now you didn't charge the 5%, and the vendor's the customer's long gone. It was 3 years ago or whatever. You're just out of pocket. This is actually a terrible thing that happens, and it happens quite a bit. So my suggestion to you is if you've crossed the $30,000 line, even though you don't want to register, please register. And by the way, some of you know that you don't charge GST to people outside of Canada. That's true. It still counts toward the $30,000 line, and you still have to register. If there's like a lot of people on this webinar right now. So somebody there has crossed the $30,000 line, didn't want to register or forgot or got busy and isn't registered and is pooping themselves right now. Stop pooping. I mean, really, just stop pooping. But don't worry about that. Just register. Register now. You can do it online. You can call them up and do it. It takes 10 minutes. Register now before they notice that you didn't. Because the other true thing about this is that let's say they go back and they see that you should have registered in 2022. And they look over and discover that you registered yesterday. So they know you're late. They won't do anything. They'll leave it there. They'll leave it there. The important thing here, if you didn't register when you should have, is to register before they notice that you should have. That's enough. You'll be fine. I've never seen them quibble over timing, so long as you get to it before they bring it up. So if there's anybody there who's crossed that $30,000 line and you didn't register and you know you should have, just register now, okay? Now, talking about people who are under the $30,000 limit and don't have to register for the GST, and I said there are some situations where you might want to. So the thing about the $30,000 line is most Canadian businesses are aware of that $30,000 line. Once you register for the GST, HST, there's one more obligation that you have with that, which is that when you invoice somebody, you have to show your GST registration number and you have to show the GST or HST that you're charging on its own line. You have to show, so an invoice from a registered person looks different than an invoice from a person who isn't registered. And what that means, if you follow the logic to the end of the line there, is that when somebody receives an invoice from you and it doesn't have the GST on its own line and it doesn't have a registration number, they know that you're not registered and they know that you make under $30,000, or at least that you may make under $30,000. Maybe that doesn't matter to you, but if you feel like it's none of their business, then the only way to disguise it is to be registered, regardless of what you make, because then they have no idea about your income. Just saying. Okay, now that is the end of my planned speech about the GST. So I know that there are questions here. Oh, so many questions. So let's see. Do you have to keep track of the GST, PST, HST you pay on your expenses you have incurred for work and claim that on your income tax return? If you're, there's two parts here. Do you have to keep track of it? If you want to claim back those taxes, if you're allowed to and you want it back, and you should, because that's the best possible outcome for you with that money, right? If you spent $1,000 in Ontario and there was an additional $130 of HST that you had to spend, you want that 130 back. That is the best thing you could possibly want. And if you want to claim it back, then you're going to have to keep track of it. So this is one of those situations where you don't have to, but for your own sake, you probably want to, because it's money. And, you know, as much work as it is to do this kind of thing, it's probably some of the better paid work out there, right? Like you do a bit of math or you write down a little note for yourself and you get $130. That's not bad. That said, um, you know, I don't spend too much time plugging my own business here, but what we do is we ask you to just report your expenses. Like we at Bonaventure Personal Tax Advisors, we ask you to tell us what your expenses were, including the GST, HST. We do the math to calculate it back out again, and we claim it back, and we adjust both returns so it fits. So we do that, but yes, one must track that stuff in order to claim it back, and you probably want to claim it back. Just checking what I heard, any grants from the government do not count in self-employed income for calculating whether you reach the $30,000 threshold. Yes, the grants are part of your taxable income in terms of income tax. You do have to report them for the most part, but they don't count toward the threshold. Now, sometimes that means that your income, your gross that shows the grant is over 30,000, but you didn't register for the GST because you know that the actual GST related income did not reach 30 grand. That will be a situation where sometimes CRA will send you a letter and go, why didn't you register? And then you just say, because most of this money was from a grant. They will understand that. Grants are exempt from the GST system, but not exempt from the income tax system. So if they're looking at your income tax returns to determine your GST eligibility, they can get that wrong. So you just have to correct them. Do you need a new number, a new GST number, if you've changed your business name or activity? Or once you have a HST number, is that the sole number you use throughout your self-employed years? Generally, you will keep that number for all your self-employment, regardless of what you do or for how long you do it. Business names, CRA doesn't care about them at all. They only care about your account numbers with them, which is your GST number, which is your business number, social insurance number. They don't care about your business name, so no, you don't have to change because of your name. The one time when you need to register again is if you incorporate. Why? Because remember, I told you that a corporation is a different person. So that person needs their own GST number. That's the only condition where you need to get another GST number. Okay, let's see if we can get through a couple more before we go through the home stretch. What if you're self-employed or an independent contractor for a company that operates out of the United States and just crossed over 30K? What types of taxes should I charge since my service is provided to a company outside of Canada? Excellent question. Um, so, as I said before, all your income from around the world is reportable on your income tax return. However, people outside of Canada do not pay GST, HST, or rather, you charge them 0%. So, for the sake of your income tax return, that income is going to show up. And it's also going to show up on your GST return, but in a special box that's reserved for income where it's part of your self employment, but it's not, there was no tax on it. So you are going to report it there, but it doesn't have an effect there. Um, so, yeah, there you go. You're going to charge 0% GST, HST to your American payers. And let's see if I've got a slide for this. By the way, if you are doing the kind of work where you can be in one place while the payer is somewhere else, so if you're a writer and you're being paid to write, you're sitting at your desk in British Columbia, and the payer is over in Ontario, you're going to charge them the GST or HST that applies where they are. Okay, so you have two different provinces here. You have the province where you are physically doing the work, and you have the province where the work is being received by the payer. As the tiebreaker, CRA considers where the work is being received by the payer as the place where the sale was made, and therefore you must charge their rate. And remember that the HST is only applicable in some provinces, and it changes from province to province. So you need to know what their rate is in order to charge it properly. By the way, one of the resources that I offered with my code there is a guide to the GST, HST, and it includes the rates for all provinces. So that's helpful. And I think I saw, okay. Yeah, I knew there'd be a few questions along this line, so I'm going to answer one more question before we move on. What if the next year after registering GST, HST, you don't make 30K? Do you still charge it? You are responsible for charging the GST and remitting it and filing and all that stuff, starting when you register and ending when you end your registration. When you first register, you have to stay registered for at least 1 year. After that, if your income plummets and you don't think it's going to come back, you can close that account and not reopen it until you hit $30,000 again. But you are responsible for charging it until you no longer have the account. Okay, so that's the lifetime of your GST, HST registration. Before you register, you don't have to charge it. You can't charge it, actually. You don't have any obligations. While you are registered, you must. Now, if your income goes up and down, as you can see, I've had this question before. Once you're registered, you must charge it and you must remit it. So I love a question that requires a slide that I already made and animated at great expensive time. That took a long time to do because I'm not that great with slides. So thank you for asking it. It makes my slide making worthwhile. There, you just proved that was the expectation of profit. I thought if I make this slide, it's going to pay off. It did. I'm so glad. Okay. Oh, sorry, I've been scanning. I didn't mean to do that. So we're going to move on. Quickly, a little bit about setting money aside for tax, and some other sort of secrets of CRA before we wrap it up. So in this way, see, this is one of the ways where the road is very smooth for employees and less smooth for self-employed people. If you are an employee or if somebody is an employee, the employer is obliged to withhold tax on their income. It's an estimate of tax owing. It's not always exact. The amount that they withhold is set by CRA with their rules about what you're supposed to withhold. They send it straight to the government on your behalf as you're earning the money, so that you basically never have the money. You just never touch the money in the first place because it went straight to CRA. And that's handy because you never really have to worry about it. You know that the amount that got deposited in your bank account is the post-tax amount, that it's all yours. But when you're self-employed, aside from having to set aside the GST, HST, you also aren't being taxed at source. Nobody is taking part of what you bill and sending it directly to CRA. I mean, unless, you've been garnished, but basically nobody's doing that for you. You're going to have to do it. You're going to have to determine how much tax you want to, how much of the money that you're earning that comes in are you going to let yourself spend, and how much is going to be set aside for taxes. So the problem with the question of how much do I set aside is going way back to the beginning of this talk, where we talked about how you're taxed on the profit. And the profit is the amount that you build minus the amount you spent. And the problem is that you know how much you build, but you kind of don't know what you spent until you do all your accounting, which most people only do if they're sole proprietors. They basically only do it once a year. So you don't know what your profit is going to be. So how do you know how much tax to set aside? And the answer is you don't. Essentially, you have to set aside a guess. Now, in my years and years of doing this kind of work for self-employed people in the arts, what we typically find is that the majority of self-employed people end up remitting to the government somewhere between 15 and 20% of their gross. Why do I express it in terms of gross? Because gross is the money that's coming in. It's at the time that you get paid that it's the easiest to set some money aside, obviously. And that is the one number that you know as it's coming in. So for most people, if they took 15 to 20% of every dollar their customers or their clients sent them, if they set that aside, it would be enough for tax, or it would be pretty close enough that it's not painful. However, if you're doing a job that really has very low expenses, like if you're doing a job like writing, um, where your only expense is a computer, and it doesn't have to be the best computer, um, or if you are just a very thrifty person, so you just don't spend a lot of money on your business because you're just good at not spending a lot of money. Your profit margins, the amount of money that the amount of profit that you make on that dollar is higher because the expenses are lower. So that means that the tax, because it's based on the profit and your profit is higher, the tax as it relates to how much money is dropping into your bank account is a little higher. So if your expenses are really low, or if you want to be super safe, if you set aside 25% of every dollar that you are paid via self-employment, you will almost certainly overshoot, at least by a bit, the amount of tax that you actually owe. So if you set that aside, put it in a separate bank account or put it in a mattress or put it wherever, you will have more than enough to pay your taxes, and any excess you can just sort of give to you as like a self-made refund. So 25 is very safe. 15 to 20 is sufficient for almost everybody. It's just a matter of how you like to manage your money. Um, okay, I see. Okay, I'm sorry. There's a question about the GST that's easy for me to answer, so I'm just going to answer it. For GST, HST, what is the year? Is it the calendar year? If we're talking about the $30,000 threshold, it's 4 consecutive calendar quarters. So they don't have to be, it doesn't have to be January to December. The first quarter, the calendar quarter is January to April to June, July to September, October to December. Take 4 of those quarters side by side, and if they exceed $30,000, that's your line. So that's that simple answer. Okay. Okay. I see lots of really juicy questions in the Q&A, and I wish I could get to them all, but I am going to try to do my final section, then I'll swing back to the Q&A. I want to end with something I'm going to end with a secret. I want to tell you a secret about CRA. It's so fundamental. It's one of those things. It's like it's so big that you don't even see it. It's everywhere. This fact about CRA, and it affects a lot. So I really hope you're sitting down for this part. If you're standing and holding something fragile, please reconsider before I tell you this secret about CRA. CRA is almost entirely run by bureaucrats. Yeah, I said it. They're bureaucrats. Now, I want to convince you of two things that you don't believe me right now. Okay, but I'm going to, number one, I don't mean that in a bad way. And number two, this matters. So when I say they're bureaucrats, and I don't mean it in a bad way, bureaucrat is a word that's got a lot of sort of baggage attached to it. But what it really means is a person who must obey a strict set of rules. They're subject to very clearly defined and strict rules. They have to be, things have to be done in exactly this way, in this order, at this time. The the rules basedness of bureaucrats is what gives them their bad reputation. But I want you to consider the idea that a tax system run by bureaucrats is run by rules. And what that means is there's no favoritism, there's no bull. Everybody, from the biggest to the smallest, the hugest, gajillionaire corporation is as responsible for filing their GST returns as you are. They have to. A CRA agent can't do something for you because they like you. They have to do it because you followed the rules. It's the only way to run a tax collection system in a civilized country. You must have a bureaucracy. However, the fact that they're bureaucrats leads to something that a lot of people don't quite get, which is just how much deadlines matter to them. We think about CRA, we think about taxes, we always think about money. Why wouldn't we? That's what it's all about, right? To you and me, it's all about money. But to a CRA agent who is a bureaucrat and does not earn commission, it's actually about the paper. They love paper. They need paper. It makes them feel secure. And not having paper or not having paper when they expect to have the paper makes them sad and cold. It makes them itchy, and you don't want that. The fact that they are bureaucrats means that making them wait for paper is worse than making them wait for money. File on time, even if you can't pay on time. If you make them wait for paper, the consequence is that they will charge you a penalty, which is like a fine. If you make them wait for money, they charge you interest, which everybody that you make wait for money charges interest, right? There's interest everywhere because because if you are holding on to money that belongs to somebody else, they're going to charge you more for making them wait. That's interest. CRA's interest rate is actually a pretty reasonable interest rate. It was 5% for many, many years. We're currently living in an era of sort of higher, elevated interest rates, so it's 7% now. But compare that to what you're probably paying on your credit card, it's pretty decent. The penalties, though, that's something else. And the penalties typically are much bigger than the interest. And this way you can see with straight numbers that making them wait for paper ends up costing you more than making them wait for money. So always, always get the paperwork in when it's due so that you don't have to pay the penalties and pay them when you can. A lot of people will get into this situation, particularly when they're new to self-employment. Remember that employees have tax withheld at source. Employees often, there's a little too much tax withheld at source. When they file their tax return, it turns out that too much has been withheld. The tax return calculates the actual amount and they get a refund of the excess. Self-employed people almost always have to pay some tax. So a lot of times when you leave employment or when you cease to only be employed, when you go into self-employment, for a lot of people, that's the first time they've ever owed any tax. And that first tax return is a shocker because they owe. And they may be tempted to not file and to wait till they have the money. Then they'll file. If they don't file CRA won't know that they owe money and won't be mad at them, and it'll be okay. And then when they've got the money, CRA will be happy. No, CRA will charge you a penalty for filing late anyway. CRA will charge you a penalty just because you didn't file the paperwork on time, and that penalty can be completely avoided if you just get the paperwork on time and make them wait for the money. The number one trigger for frozen bank accounts. This has happened when people call me and say, my bank account's been frozen. The only reason I have ever encountered in 20 years, 23 years, is unfiled GST returns. Not unpaid GST amounts, unfiled returns. And sometimes the person will say, well, I didn't do any business. I tried this thing and I registered for the GST because I thought I had to. And then I just didn't really work out. And I got hired by a big company and I just took the job and I haven't done anything. CRA doesn't know you didn't do anything because you haven't filed a return. File. You need to file. It's important. Speaking of deadlines, April 30th, of course, we're not Americans. Americans, April 15th, Canada, April 30th is your tax filing deadline. So please file your taxes by then. But wait, maybe you don't have to, because actually, self-employed people have an extended tax filing deadline. People can be self-employed for years sometimes without knowing this. I've discovered this in my many years upon the earth, that there are a lot of self-employed people where nobody ever told them this. If you have any self-employment income, I don't mean like if it's your only income. I mean any income. You can have a regular job and make $100 self-employed. Any self-employment income, you get an extra 6 weeks to file. Not only that, not only is your filing deadline extended to June 15th, but your spouse or your common law partner also gets the extra 6 weeks just for being with you. So I really recommend bringing that up in an argument when we're, like if you're totting up the score. They get an extra 6 months, because, sorry, 6 weeks, sorry, 6 weeks. They get the extra 6 weeks to file because you have self-employment income. Who knew, right? So that's a good thing to know. Now, some of you may say, but Sunny, uh, don't I still have to pay my taxes by April 30th? Taxes are due on April 30th. That's true. The money is due on April 30th. If you file on June 15th and you pay then, what's happened? You filed on time, but you've paid late. You've paid 6 weeks late. There will be an interest charge of maybe half a percentage point on whatever it is that you owe. That's what the interest would be on 6 weeks. For most people, in fact, yeah, for most people, it's a negligible amount. It really doesn't matter. So get the return in on time. I just gave you an extra 6 weeks, so take it and run. But even if you feel like you cannot pay that tax return, that tax bill, get the return in on time to avoid the penalty. The penalty is 5% of what you owe right off the bat. So if you're one day late, your income tax bill just went up by 5%. If you are another month late, 6. Another month late, 7. To a maximum, the first time you're late, to a maximum of 12 months, you'll owe 17% extra on your tax bill because you waited, plus the interest dating back to when you're supposed to pay. And at that point, you'll probably say, well, it would have been nice to have the return in and only owe the interest instead of the penalty and the interest. Damn right. File on time, even if you can't pay on time. And now, for the next 16 minutes, I can devote myself to this Q&A. Okay. If I accidentally opened a second GST account, so I have two numbers, can I close the second one? Yeah. Contact CRA, or you can do it online too, where you just sort of like opt to close it. You have to set a date on which you're going to close it. So it'll ask you, like, you have to pick which number you're going to close. Make sure you keep it straight, which one you're closing. You're going to specify what date on which it's official. You have to file all the tax returns, even if you weren't billing anything on that account. You have to file all the tax returns, all the GST returns for every period during which that account existed up to that closing date, and you're done. You can also backdate a little bit. We are currently in the first quarter of 2026. You can backdate it generally to the beginning of the quarter that you're in. So if you are in the situation where you have two GST numbers, or you have a GST number that you want to close now because you're below 30,000 and you don't think you're going to be back, or you've got two and you don't want to, you could probably backdate that to January 1st. So then you just have to file up to December 31st of 2025 and you're out. So that's what I recommend you do. Um, what is a standard or safe percentage of home to deduct? So we're talking here about business use of home. Um, the way business use of home works is that you take the full cost of your overhead, and so it's basically your rent and utilities, or your property tax and mortgage interest and utilities. That's your overhead costs. You're going to take that as a big number, and you're going to multiply it by a percentage. The percentage is the percentage of floor space that your workspace takes up. Okay. So, and they do sometimes, when you're in review, they do sometimes ask you to like produce like a floor map of the floor plan of your home to show them how you got that percentage. So the percentage should always be based on the actual square footage of your workspace divided by the square footage of your entire home. Or you can take the number of complete rooms your self-employment takes up divided by the total number of rooms. Those are both allowed by CRA's rules. So just do it both ways and take the whichever one is lower, that's going to be your percentage. So there's no standard, there's no safe, there's just what's true. I pay for some services like writing corrections, book cover, etc. overseas. Do I present that on my taxes? Those are business expenses. If you have the records to defend that you spent them, and they follow the reasonable expectation of profit, you may write them off. Remember that you don't have to write off anything if you don't want to, but you want to because it lowers your taxes. So absolutely, the income earned around the world is taxable. The expenses spent anywhere on planet Earth, if it relates to your business and it relates to making more money in your business, is deductible. And for your own sake, you should deduct it. Can we keep the GST money in a TFSA account until the end of the year before we do taxes? Yes, not a bad idea. It'll grow there and it'll grow tax-free because that's the rule about TFSAs. Yeah, that's absolutely a good thing to do. Now, I will say that there comes a point, and this is true of both income taxes and GST. If so when you first start all this stuff, you are going to be filing a return once a year, or usually once a year, and paying all your taxes sort of in one go if you set it aside, if you got it available. If the amount of tax that you owe exceeds $3,000, and if that becomes typical for you, by typical for you, CRA, which defines everything according to rules, means if that happens, if you owe more than $3,000 for 2 out of 3 consecutive years, they consider that to be habitual. And from that point, they're going to want quarterly installments, which you don't have to pay. You can pay quarterly installments or not. If you don't pay the quarterly installments, they may assess interest backdated to when the installments were due. Now, I will get to why I'm bringing this up here. This is true of both income tax and GST as separate systems. If you owe more than $3,000 a year in income tax, they're going to ask for installments. If you owe more than $3,000 in GST, they're going to want installments. And either way, if you don't pay those installments, there may be interest attached because now your deadline for payment has been split into 4 and they're back through the year, right? My point being that although it makes financial sense to take the money that you're going to give to CRA and put it in your TFSA, if you have the room, the fact is, after a while, it's not going to be worth it because if the amount that you're setting aside is very small, it's not earning that much in the TFSA anyway. It's only there for a year and it's small.
And if the amount is big, pretty soon you're going to have to pay installments or pay interest. And the interest that they're going to charge you because you held on to it for the year is going to exceed the tax benefits and the investment benefits of having it in the TFSA, if that makes sense. If you're clever enough to come up with this scheme of putting it in the TFSA to grow it and then taking it out, then you're clever enough to understand if the interest charge of holding it for yourself exceeds the profit from the investment, it wasn't worth doing. And generally, while CRA's interest rates are reasonable, um, generally those interest rates are going to be higher than what you could have earned by having the money in your pocket. Unless you're very lucky or very, very savvy. That's possible too. Um, oh, this is sweet. Will you be doing another? Thank you for your compliment. Will you be doing another corporation boot camp in the future? I have a lot of corporation questions I would love to ask you. Um, that is not a question for me. That is a question for AFC. And I'm not going to have them come on and answer it now. They can maybe, I don't know, answer it in the chat or whatever about what the plan is. This year, the next one we're going to do is about audit proofing. I don't know if they have plans to do a corporate one or not, but maybe if you clamor for one, they'll hire me a third time. Who knows? But thank you for your kind words. Thank you. Um, let's see. Do you still have to pay GST even though you worked outside of Canada and didn't charge for it? Only pay taxes in Canada and live here. So remember what I said, that you only remit what you collect, and you collect 0% from non-Canadian payers. So while you're outside of Canada, or while you're billing people who are outside of Canada, you're not charging any GST. What amount do you have to remit? 0. However, you still have to file the return to say that you did that. So you still have to file. You never, ever have to remit GST or HST that you didn't collect. That's not how the system works. You only remit what you collect. Unless you've got a very complex sort of importation business, but that's beyond the scope of this talk. Um, how much income can you earn and not pay tax at all? It's different for Canada and provincial, right? Yes. There is a basic personal exemption in each province and in Canada wide. They're not the same, but they're usually pretty close. They change from year to year. They increase with sort of the cost of living. Right now, they're around, I think, $16,000. So that's the amount that you can earn without paying tax. However, you have to pay into CPP when you make over $3,500. So you will be paying into the pension plan before you are taxable. This is a good thing. The amount of pension that you collect at the end of after your career is over is more than you pay into CPP, but it does depend on what you paid into CPP. So you want to take any advantage, any opportunity to pay into CPP. Trust me, it's to your advantage. Pay into it. Don't complain. It's good. So, however, I would not recommend anybody aim to make so little money that they're not taxable. Make more money. You'll hear people, especially people who make a lot of money, who are either stupid or lying about what they understand and don't understand. They'll say, oh, you make enough money, the taxes eat it all up. Impossible. Tax is always a percentage of what you earn. That percentage goes up as you earn more, but it only goes up on the additional amounts. Bottom line is, making more money and paying the tax still means you make more money. You still get more money. There is no situation, none, where you make more money and end up with less because of taxes. It's mathematically impossible. And if you want any proof, if math isn't your bag, if really making more money means that you pay so much tax that you don't get to keep any, it's not worth it, then why does everybody keep trying to make more money? Rich people who tell you, oh, it's not even worth it, still will do anything to make more money, even if they're paying their taxes, right? More money, it's good. Do not aim to not be taxable. Aim to be taxable. Aim to be super taxable. Please aim to be very taxable. I hope you all succeed in being extremely taxable. If I have two self-employment jobs, example, I'm an actress and a seamstress, and I do clothing alterations at home, can I file taxes for both? If you're not incorporated, both anything that you're doing through as self-employment, regardless of its nature, is income to you. It's all reported on a single income tax return. Your personal income tax return records all the money you made from everything you did anywhere in the world. It's all there. Your work as a seamstress, your work as an actress, any work that you do if you take a part-time job, all the money gets reported there. So there's only one return. Now, if you're saying, do I have to report two sets of income and expenses for acting, income and expenses for seamstress? You can and one advantage of doing it that way is that you can see how each business is doing and maybe deduce from that what is worth throwing more energy into. But you don't have to, because in the end, CRA doesn't really care. Income in, expenses out from all sources. So it's only one return. Is it bad to make a small contribution every month to an RRSP, even if your TFSA isn't yet maxed? It's never bad to make a contribution to an RRSP, but there are better situations and worse situations. What an RRSP does is, like, let's say, okay, you made a bunch of money, you spent a bunch of money, and you have this net profit, and that's what you're getting taxed on. Okay. We're going to use a number. Let's say you made $50,000. It's just a number. $50,000. That's your income. You're going to get taxed on $50,000. Well, minus the exempt part, but whatever. You're going to get taxed based on $50,000. But if you put $5,000 into an RRSP, you will only be taxed on $45,000. So they take the amount that you earned minus the amount that you put in an RRSP, and they tax you on that. That's how RRSPs reduce your taxes. However, our income tax system in Canada is stratified. It's progressive. By progressive, it means that the more money you make, the higher your tax rate is. However, what happens is the first chunk of money you make is exempt, no tax. The next chunk of money you make is taxed at 30% or so. The next chunk of money you make is taxed at 34% or whatever. So these additional tax rates only apply to certain parts of your income. RSPs come off the top. So if you have some income that's being taxed at 0 and some at 20 and some at 30, it's reducing the tax on the 30. So it's reducing it at a rate of 30%. What that means is that the more money you make and the higher your tax bracket is, the more tax an RSP contribution is saving you on the dollar. People who are making shitloads and put money into an RSP, so a person who's making $200,000 and puts money into an RSP, they'll save 40% of that on tax. So they'll put $1,000 in and they get $400 back. But a person making $23,000 who somehow finds a way to put $1,000 in will only save $200. RSPs are designed to give you a break when you are in your highest tax earning years. And because of that, if you are a low earner, they're not doing you as much good. If you're in a low tax bracket, and for me, I would say anybody below about 50, 60,000. If you're there or below, prioritize your TFSAs. The money is still gonna grow tax-free. Wait until you have a really good year. And then throw a bunch of it into your RSPs. Heck, take it out of your TFSA and put it in your RSPs so you can get the deduction when it can do you the most good. So it's perfectly fine to put money in an RSP when you haven't maxed out your TFSA. These have they're optimized for different things. So go ahead and do that. Just be aware of what you're doing. And if your income is really low and you want to set some money aside, think about the TFSA instead of the RSP. And it is 3 o'clock.
Yep, I was just about to jump in and let you know that we're at time.
That's fine. Okay. Well, I really thank you all for as I expected, there were so many more questions that I could have answered and I want to answer, but we're out of time. And frankly, I need to lie down on the floor for a little bit because I'm tired. But it has really been a pleasure talking to you all. You've been so active in the chat. I've been seeing the chat moving around. I haven't been able to track it, but I can see the activity. I can see you're talking to each other. So many questions in the Q&A, such good, thoughtful questions. And I really appreciate your participation and your willingness to spend a couple of hours with me today to learn more about your taxes. And just to conclude, I told you why I do this. It is because everything you need to know to stay out of trouble now, you know. I just told you all of it. I hope that you've inferred from all this that even though you might not love it, it's not impossible, it's not beyond you, you can do it. And doing it is so much better than not doing it and getting caught later. Because the bottom line is, it is always so much easier to stay out of trouble than to get out of trouble. And I hope that I've given you the tools to keep you out of trouble. And with that, I'm handing it back.
Thank you. Thank you very much, Sunny, for this, so in detailed workshop, webinar. And thank you everyone for joining us. We will be sending a follow-up feedback survey. Please make sure that you fill out the feedback survey so that we can keep bringing you better and better workshops every time. Thank you, Laura. Thank you, Sunny. Thank you everyone once again. Have a good day.